In this lesson, how to trade wedge chart patterns, the learning objectives are: you should understand the different types of wedge chart patterns, and you should know how to properly enter a trade using the wedge chart pattern. Wedges are a tool that you can use to trade. They are a trusted pattern that many traders use. Wedges can be seen as either a continuation or a reversal pattern. Wedges signal a pause in the current trend. So when you encounter this formation, it signals that traders are deciding where to take the currency pair next. As you can see from this example, a wedge is just simply two trend lines that converge towards an apex being the point at the end of the two lines. This is because price is compressing from both selling and buying pressure. Wedges can appear in all time frames. Most often, wedges are used on shorter term time frames. The reality is, you can see them on a daily and weekly charts as well, and it could be argued that they have much more importance on higher time frames because it takes much more time to form the pattern. Here we have a rising wedge, also called an ascending wedge chart pattern, and it is recognizable price move that's formed when a market consolidates between a converging upward sloping support and resistance lines. The higher highs make a rising trend line, as you can see, and this forms the resistance, and the higher lows make a lower rising trend line. This forms the support line. With this formation, there should be 3 peaks and 3 valleys, and 3 touches to each trend line. It may not always be like this, but this would be the perfect example, with the 4th acting as the decisive one, where you would expect movement, as you can see here. Both the upper and lower trend lines should rise more, and the upper trend line should rise more steeply than the lower trend line, so it would form this wedge. Tall and wide patterns work better than short and narrow patterns. Sometimes the slope of the support line is steeper than that of the higher highs. This indicates that the higher lows are being formed faster than the higher highs. This leads to a narrowing wedge. This would mean that instead of being like this, it could be sharper, meaning that it touches at the end like here. If the rising wedge forms after an uptrend, it's usually a bearish reversal pattern. On the other hand, if it forms during a downtrend, it could signal a continuation of the downward move. Simply put, a rising wedge leads to a downtrend, which means that it's a bearish chart pattern. The target for this pattern is the full height of the pattern, like always, but we'll get onto this in a moment. The descending wedge chart pattern is a recognizable price move that's formed when a market consolidates between converging downward sloping support and resistance lines. The lower highs make a falling trend line. This forms the resistance line. The lower lows make a lower falling trend line. This forms the support line. With this formation, just like the rising wedge, there should be 3 peaks and 3 valleys, and 3 touches to each trend line. With this little bit here acting as the decisive movement. The lower the trend line should fall more steeply than the upper trend line, forming a wedge. And tall and wide patterns again work better than short and narrow patterns. If the falling wedge forms after an uptrend, it's usually a bullish continuation pattern. On the other hand, if it forms during a downtrend, it could signal a bullish reversal. Simply put, a falling wedge leads to a uptrend, which means that it's a bullish chart pattern. There are also broadening wedges, more specifically broadening bottoms and broadening tops. These open outwards. They represent increasing volatility within a broadening range. Broadening tops and bottoms look the same. Broadening tops are formed after price rises. Broadening bottoms are formed after price falls. The preceding price action determines the pattern name. The patterns are formed by drawing a trend line on either side of the price peaks and troughs. There has to be 2 touches to form both trend lines, 2 on the top and 2 on the bottom. But just like the rising wedge and falling wedge, there can be 3 or even 4. The trend lines should be in opposite directions. The width between them broadening, which means it's increasing. Let's look at this example here. It's going away from each other. As you can see, the upper trend line is pointing upwards and the lower trend line is pointing downwards. And this is the same with the broadening top. Very often, these patterns have partial rises and partial declines that are followed by a breakout. These are when price rises from the lower trend line and fails to touch the upper trend line. It is likely to break out lower, and when the price falls from the upper trend line and fails to touch the lower trend line, then the breakout is likely to be higher. What does this mean though? It means that if the price does this, which is very common, when it goes up but stops here, so it will just stop here and start going back up again. If you see this, this is a very bullish sign because it means that there's not enough sellers to push the price back down. And if you see that, you should enter a buy. And the same goes for here. If it touches the bottom and then fails to make another move upwards and instead turns, you should enter a sell because it's likely to break out. And the breakout occurs when the price closes on the outside of the pattern, above the upper trend line or below the lower trend line. And you should trade in the direction of the breakout. However, you should be careful because there is no definitive number for the amount of times that it could touch the trend line. So you should extrapolate the trend line, meaning you should extend it out and you should make sure that the price goes past it cleanly, closing above this line here. This one here. There are also right-angled broadening wedges. Right-angled broadening wedges come in 2 varieties, ascending and descending. They consist of a horizontal trend line and a sloping trend line. The ascending right-angled broadening wedges have an ascending trend line, and they're above the horizontal trend line, as you can see here. The descending right-angled broadening wedges have a descending trend line below the horizontal trend line, with price action in between. Price should touch both trend lines 2 or 3 times. This means 2 or 3 touches to form the horizontal trend line and 2 or 3 touches to form the sloping trend line. Breakouts from these 2 patterns often follows a partial rise, which again is just a small movement upward from the, let's say, the support line here. So it could mean, let's use this example. There's a small movement upward from the support, fails to touch the trend line again, and then proceeds to fall. Often, right-angled ascending broadening wedges break out downwards, and for the descending right-angled broadening wedges, the breakout is often completely random. Like, it would make sense if it would go up, but they are less reliable than the ascending right-angled broadening wedges. Pullbacks into the pattern after a breakout do occur regularly, so you should place your stop losses accordingly. If you think that there's going to be a breakout to the downside, you should place your stop loss above the trend line. And for your profit target, you should measure the full height of the wedge, and then use this height to project where you think the target will be by adding it onto the breakout in the direction of the breakout. In summary, wedges are a technical pattern that traders use to identify upcoming bull and bear markets. Falling wedges often lead to bull markets, while rising wedges often lead to bear markets.